Meet Whiskers, your friendly neighborhood tabby who happens to be really good with numbers. Now, Whiskers has been tracking some interesting developments in the financial world, and today he wants to tell you about one of the most notorious scams in Wall Street history. You see, back in the 1990s, there was this guy named Jordan Belfort who pulled off one of the most elaborate financial frauds ever recorded. And trust me, after spending countless hours by the window watching birds and observing human behavior, Whiskers knows a thing or two about spotting when something doesn't smell right. So picture this. It's 1989 and Jordan Belfort decides to start his own brokerage firm called Stratton Oakmont with his business partner Danny Porish now. From the outside, this looked like any other Wall Street firm. Fancy offices, sharp suits, and lots of people making phone calls about investments. But underneath all that glitter and glamour was something much more sinister. What Belfort created wasn't a legitimate investment firm. It was what financial experts call a boiler room operation, designed specifically to separate ordinary people from their hard-earned money. Here's how the scam worked, and pay attention, because this is where things get really interesting. Belfort and his team would first identify small, unknown companies with penny stocks. These are stocks that trade for very low prices, usually under $5 per share. The beauty of penny stocks, from a scammer's perspective, is that they're easy to manipulate because they don't have much trading volume. It's like having a small pond where even a tiny splash can create huge waves. Once Belfort identified these companies, he and his associates would quietly buy up large quantities of their stock at rock-bottom prices. Think of it like hoarding your favorite treats when they go on sale, except instead of treats, it was worthless company shares. After accumulating significant positions in these stocks, the real criminal activity would begin. Belfort had developed what he called the straight line system, which was essentially a high-pressure sales script designed to manipulate potential investors. His brokers would call unsuspecting individuals and start with what seemed like a legitimate investment opportunity. They'd begin by recommending a well-known blue-chip stock to build trust and credibility. This was the bait. Once the client felt comfortable and opened an account with Stratton Oakmont, that's when the trap would spring. The brokers would then pivot to selling the client shares of the penny stock that Belfort and his team had already accumulated. But here's the crucial part. They weren't just recommending these stocks as good investments. They were using sophisticated psychological manipulation techniques to create a sense of urgency and exclusivity. They'd tell clients that this was a once-in-a-lifetime opportunity, that the stock was about to explode in value, and that only their most valued clients were being given access to this incredible deal. What made this scam particularly effective was that Belfort specifically trained his brokers to target middle-class investors rather than wealthy institutional investors. These were regular people with retirement savings, college funds for their children, and emergency nest eggs they'd spent years building. Belfort knew that these individuals were less likely to have the financial sophistication to spot the red flags, and they were also less likely to have the resources to fight back legally if things went wrong. The pump part of this pump and dump scheme worked like clockwork. As more and more investors bought into these penny stocks based on the false recommendations from Stratton Oakmont brokers, the stock prices would start to rise. This created what appeared to be legitimate market momentum. Early investors would see their portfolios growing and might even recommend the stock to friends and family. The artificial demand created by Belfort's sales operation would drive prices higher and higher. But here's where the criminal genius and the devastating human cost become clear. Once the stock price had been pumped up to artificially high levels, Belfort and his associates would dump their shares. They'd sell their massive holdings at the inflated prices, making enormous profits. Since they had bought the stock when it was worthless and were now selling it at dramatically higher prices, their returns were astronomical. The problem, of course, was that these stocks had no real value. The companies behind them weren't actually worth the inflated stock prices. So once Belfort and his team finished selling their shares, there was no more artificial demand to prop up the prices. The stocks would crash back down to their true value, which was often close to zero. This left all the legitimate investors holding worthless paper. People who had invested their children's college funds, their retirement savings, or their emergency money would watch helplessly as their investments became worthless overnight. Many victims lost everything they had worked decades to accumulate. The emotional trauma extended far beyond the financial losses, destroying trust in the financial system and devastating entire families. At its peak, Stratton Oakmont employed over 1,000 people and was handling roughly $1 billion in investments. The firm had created a culture of extreme excess, with lavish parties, expensive cars, and a work environment that glorified greed and unethical behavior. Belfort himself became incredibly wealthy from this scheme, living a lifestyle of absolute luxury funded entirely by the money he was stealing from ordinary investors. What made this operation so successful for so long was its sophisticated structure. This wasn't just one person making fraudulent phone calls. It was an entire organization with multiple layers of deception, training programs for new brokers, and systems designed to avoid detection by regulatory authorities. The National Association of Securities Dealers had been investigating Stratton Oakmont almost from its inception, but the complexity of the fraud made it difficult to build a solid legal case. The human cost of Belfort's crimes extended far beyond simple financial losses. Victims experienced feelings of betrayal, shame, and complete loss of trust in financial institutions. Some elderly investors lost their ability to retire comfortably, while others watched their children's educational futures crumble before their eyes. Marriages fell apart under the financial strain, and entire communities felt the ripple effects as neighbors and friends discovered they had all been victims of the same elaborate con. But the story gets even more twisted when you consider the culture that Belfort created inside Stratton Oakmont. This wasn't just a criminal enterprise disguised as a business. It was a full-blown circus of excess and moral bankruptcy. Employees were encouraged to live like kings on money stolen from hardworking families. The office parties were legendary for all the wrong reasons, featuring everything from substance abuse to outrageous displays of wealth that would make even the most pampered housecat blush. Belfort himself became the poster child for this lifestyle of stolen luxury. He owned multiple mansions, expensive yachts, and a collection of sports cars that most people could only dream about. Every single dollar funding this extravagant lifestyle came directly from the pockets of his victims. While families were losing their homes and retirement savings, Belfort was throwing parties that cost more than most people make in a year. The psychological manipulation tactics used by Stratton Oakmont brokers were incredibly sophisticated. They weren't just reading from a script. They were trained in advanced sales psychology designed to break down a person's natural defenses against high-pressure sales tactics. The brokers learned how to identify emotional vulnerabilities and exploit them ruthlessly. They would ask probing questions about a potential victim's financial goals, family situation, and fears about the future, then use that information to craft personalized pitches that were nearly impossible to resist. For example, if a broker discovered that a potential victim was worried about having enough money for retirement, they would craft a story about how this particular stock investment could solve that problem completely. They would paint vivid pictures of financial security and comfortable golden years, all made possible by this one amazing investment opportunity. The victims weren't just buying stocks. They were buying dreams and peace of mind, which made the eventual betrayal even more devastating. The training programs at Stratton Oakmont were like masterclasses in financial manipulation. New brokers would spend weeks learning not just what to say, but how to say it. They practiced voice inflection, timing, and psychological pressure techniques. They learned how to handle objections, how to create false urgency, and how to make people feel like they were missing out on the opportunity of a lifetime if they didn't act immediately. What made this particularly insidious was that many of the brokers genuinely believed they were helping people. Belfort was so good at manipulation that he convinced his own employees that they were providing a valuable service. Some brokers thought they were giving ordinary investors access to exclusive opportunities that were normally reserved for the wealthy elite. This self-deception allowed them to be more convincing on the phone because they weren't consciously lying. The regulatory authorities were playing a constant game of cat and mouse with Stratton Oakmont. The National Association of Securities Dealers knew something wasn't right almost from the beginning. But proving securities fraud on this scale required an enormous amount of evidence and coordination. Belfort and his team were constantly evolving their tactics to stay one step ahead of investigators. They would use coded language on recorded phone lines, rotate through different penny stock companies to avoid patterns, and even set up shell companies to obscure the paper trail. When one scheme started attracting too much attention, they would simply pivot to a different stock or a different approach. It was like trying to catch smoke with your bare paws. The international scope of the fraud also made prosecution more complicated. Belfort had offshore bank accounts, shell companies in multiple countries, and a network of associates who helped launder the stolen money through various legitimate-seeming investments. Some of the money was used to purchase real estate, artwork, and other assets that could be easily moved or hidden if law enforcement got too close. By the mid-1990s, the walls were starting to close in. The sheer volume of investor complaints had reached a level that could no longer be ignored. Federal investigators were building criminal cases, not just civil violations. The FBI had begun infiltrating the organization and gathering evidence of the systematic fraud. Former employees were starting to cooperate with law enforcement, providing insider information about how the schemes actually worked. But even as the investigation intensified, Belfort continued expanding the operation. He was addicted not just to the money, but to the power and prestige that came with running what appeared to be a successful Wall Street firm. The lifestyle of excess had become so normal that he couldn't imagine living any other way. Any other way. The inevitable collapse came in December 1996, when the NASD finally expelled Stratton Oakmont from the securities industry. By 1999, Belfort was indicted for securities fraud and money laundering. He eventually pleaded guilty and was sentenced to 4 years in prison, though he served only 22 months. The court ordered him to pay $110 million in restitution to his victims, money that many of them are still waiting to receive in full. Today, Belfort has transformed himself into a motivational speaker and sales trainer, charging between $100,000 to $200,000 per speaking engagement. He's made millions more from book deals and movie rights, essentially profiting again from the same crimes that devastated so many families. While his victims continue struggling with the financial aftermath of his fraud, Belfort lives comfortably in Miami, teaching others his sales techniques. The Wolf of Wall Street case teaches us that financial predators often target the most vulnerable people with the most convincing lies. They prey on our natural desires for financial